Good afternoon to everyone who is joining us today for the first in our series of webinars on inheritance tax and capital tax planning. My name is Patrick King. I'm a tax partner in MHA McIntyre Hudson and head of our entrepreneurial business section for tax purposes. I'm joined today by James Kipping, also a tax partner in our firm, and he's head of our private client tax section. Today's seminar is going to focus on inheritance tax. In the next one, we should be looking at wills, trusts, and powers of attorney. And the third will concentrate on property in the current climate, particularly buy-to-let and certain landlord and tenant act issues. So firstly, just a little bit about us. McIntyre Hudson, we're a large, medium-sized firm in the UK, about number 15 in the country, 900 to 1,000 partners and staff. We cover that light green area in the bottom right-hand corner of the UK. You can see there in the top right-hand corner of the slide on the screen there. The rest of the UK we actually do cover largely via our national association called MHA. And MHA as a whole is the UK member firm for Baker Tilly International, which is an international network that sits at about 9 in the world in terms of rankings. So we have genuine global reach where we need it, and it does work. I'm quite heavily involved in the international side, and we do have good links pretty much anywhere you might need it. But that's enough about us. Go on to what we're going to be doing today. First, I'm going to hand over in a minute to James, who's going to talk through inheritance tax and domicile. Inheritance tax is unique among UK taxes, quite possibly in the world actually, in being dependent on one's domicile rather than residence. And James will talk a bit more about that in a minute. Then it'll be handed back to me to talk about nil rate band, residence nil rate band, and one or two other bits and pieces with regard to reliefs. Then I'll hand back to James, who will do some of the main inheritance tax reliefs before it comes back to me to finish up with what we see at the moment, at least, as the future of inheritance tax, or at least an indication of what it might be, and that now is indeed a good time for planning, and perhaps why, and what some of the things are you might like to think about. So if I can hand over to you, James, now to do the first bit.
Thank you, Patrick. As Patrick said, the UK inheritance tax is unique in that it really hinges upon someone's domicile as opposed to their residence. So, of course, it's firstly important to introduce the concept of domicile and its importance for inheritance tax. Broadly, inheritance tax is chargeable on individuals who are domiciled in the UK or who have assets in the UK. So what that means is the estate of a UK domiciled individual will be liable to inheritance tax on its worldwide assets, whereas for a non-domiciled individual, they will be liable to inheritance tax on their UK assets only. Now that's the general rule. As with all things in tax, there are exceptions, but most notably being the indirect ownership of UK residential property. Now, to put this into some context, non-UK domiciled individuals may previously have held UK residential property in offshore structures to ensure that their situs was overseas. So, for example, if they held a UK residential property in, let's say, a Jersey company, that would be regarded as a non-UK asset, so would not be subject to UK inheritance tax. Now, from April 2017, that has changed so that indirect ownership of UK residential property is subject to inheritance tax. Next slide, Patrick. So, what is domicile? Well, as Patrick said at the start, it goes beyond residence and broadly can be summarised as a person's permanent home, kind of where they belong or where they believe they belong. This can sometimes lead to some surprising results. For example, an individual can be domiciled in a country in which they have never set foot. An individual's domicile is not necessarily the same as their nationality or the country in which they happen to be living. So a person can, sorry, that would be the next delivery for the wife. And as I was saying, an individual's domicile is not necessarily the same as their nationality or the country in which they happen to be living. A person could be a British citizen who has been resident in the UK for many years, yet be domiciled elsewhere. Now, Domicile can be acquired in one of three different ways, as summarised on the slide. Firstly, everyone has a domicile of origin. Usually it's taken from their father, so someone would take on their father's domicile. But if their father is deceased before they are born, or if they are born to unmarried parents, then the child takes on the domicile of origin of their mother. The domicile of dependency is mostly relevant to minors, in that a minor will follow, or rather a minor's domicile will follow that of their parents. But strangely, before 1st of April 1974, married women were considered dependents. So women who are married before 1st of January 1974 actually take on the domicile of their husband. Most interesting from a tax perspective is the domicile of choice, which can be acquired where an individual resides in a particular jurisdiction and has the intention to reside there permanently and indefinitely. Now, it's that intention that is so important for tax purposes. And you can imagine a situation where someone with a UK domicile of origin, with significant overseas assets, for example, might want to acquire a domicile of choice elsewhere if they have left the UK, so that their non-UK assets aren't subject to inheritance tax. It can actually be very difficult, and it's been held so in the courts, to demonstrate an acquisition of a domicile of choice elsewhere. Just to highlight a couple of relevant points that has come out of case law over actually hundreds of years. The intention must be directed exclusively towards one country. So it's not sufficient just to abandon connections with the UK, for example. You have to actually have a residence elsewhere and a residence in which you intend to reside permanently and indefinitely. It's often referred to that someone's desire to be buried in a country should be taken into account. And that came out of the case of Stevenson and Mason back in 1878. Whilst this is often talked about, it's not necessarily determinative in determining where someone is domiciled. For example, buying a burial plot in a new country could be a clear indication of intention to acquire a domicile of choice there. But say a wish to be buried in the family burial plot at home, so in the old country, may not be given much weight if there is no other evidence of an intention to return. Next slide. An extension of the common law concept of domicile is the inheritance tax concept of deemed domicile. So this is where there are situations where someone is not legally domiciled in the UK, but will be treated as such for inheritance tax purposes. Firstly, on the slide here is the concept of the returning formally domiciled individual. This is where someone has a domicile of origin in the UK, but has left the UK and acquired a domicile of choice elsewhere. If they come back to the UK and they are resident in the UK for one of the 2 prior years, then they will be immediately regarded or deemed domiciled again in the UK. So you can't acquire a domicile of choice elsewhere, come back to the UK more than very temporarily and retain that non-UK domicile. Then there's the kind of general deemed domicile concept, which until April 2017 required someone to be resident in the UK for 17 out of 20 years before they were deemed to be domiciled here for inheritance tax. That rule was widened in 2017, so that once someone is resident in the UK for at least 15 out of the last 20 years, then they are deemed to be domiciled here in the UK. They also need to be resident in the UK for at least one of the 4 years ending with the relevant tax year. So what this means is if someone leaves the UK and is outside the UK, or rather non-UK resident, for at least 3 years, then they will lose their deemed domicile status. Now, I suppose the main reason for me wanting to highlight the concept of deemed domicile here is that it can bring people within UK inheritance tax, but there are plenty of planning opportunities that can be done to keep non-UK assets outside of the scope of inheritance tax before that deemed domicile becomes effective. So if you or your clients are coming up to the 15 up to 20 year threshold, then do get in touch for further advice. And I'll hand back to Patrick now to talk about nil rate bands and other exemptions.
Oh, thanks, James. I would imagine quite a few people listening to this will recognise this gentleman. It is, of course, George Osborne, who helped David Cameron win somewhat of a surprise majority in the 2015 general election. And one of the ways that he is generally regarded as having done that is by his promise that no one with a house worth less than £1 million, at least no one in a married couple with a house worth less than £1 million, need pay inheritance tax on it. And by the tone of the slide, which says promises, promises, you probably have a clue that perhaps it wasn't quite what we all thought it might be when he first announced that as a policy. But let's go and have a look at it. So, the nil rate band is the allowance that everyone in the UK has before they have to worry about inheritance tax. So everybody can have an estate at the time they die, or can give away earlier than that, and more detail later on that, up to £325,000 worth of value before they end up paying inheritance tax. That's the nil rate band. Mr. Osborne announced this magic £1 million related to people's residence. And the way he achieved that was to introduce a new relief called the residence nil rate band. No one can ever accuse a Chancellor of not having imagination of names. Now you can see that was brought in at £175,000. £175,000 and £325,000 makes £500,000, which is not £1 million, I hear you say. But of course, he was aiming at married couples, and that includes people in civil partnerships. And of course, if you add two £500,000 together, you do get the magic £1 million. It was brought in over a 3-year period. It is now fully in and available, but it's not perhaps quite as beneficial as you might think, because it is tapered away as soon as your estate has a value of more than £2 million. And that's a gross value of the estate. So, for instance, if you have a property worth £1 million and you also have a family business worth, say, £5 million, that's a total estate of 6. The £5 million family business could quite possibly be covered by a relief called business property relief, which James will talk about later. And business property relief will often be available at 100%, i.e. there'll be no inheritance tax on it. So you could be forgiven for thinking that your estate, yes, is 6 million, but you take off the 5, you're left with 1, that's less than 2, and therefore you get the relief. But that's not how it works. The residence nil rate band is based on a gross estate. So the full 6 million is taken account of, which is obviously over 2 million, and therefore, in fact, that person will get no residence nil rate band at all. The way it actually works is that for every £2 that your estate's value exceeds £2 million, you lose £1 of your residence nil rate band. So once you get to 2,350,000, I think it is, if I'm doing the maths, you will get no residence nil rate band. So yes, it's worth having, but perhaps not quite as good as Mr. Osborne led us all to believe. But it was good enough for the voters, and they did win the election. Both the nil rate band and the residence nil rate band are transferable, which means that when one spouse dies, and this is not restricted by date, so even if a spouse died many years ago before the residence nil rate band was in place, potentially the relief they would have had it been available is available at today's rates to pass on to the surviving spouse. So that's a very important bit of work that we have to do when considering an estate as to whether there is any transferable nil rate band or indeed residence nil rate band available. The residence nil rate band also requires the property or the estate to be passed on to an immediate relative, including stepchildren, which is just worth mentioning. So moving on, the 7-year rule. A fairly main relief within the UK inheritance tax system is what's called the potentially exempt transfer rule, and that allows transfers of any amount to be made in most circumstances to a beneficiary in such a way that they are regarded as potentially exempt. So there's no tax due provided certain things happen. And in the main, the certain thing that needs to happen is that the person who is making that transfer needs to live for another 7 years. Provided that person does live the required 7 years, that transfer becomes exempt completely. It will not be charged a tax at all. And indeed, the individual who's made that gift will also, at that point, acquire a new nil rate band. So that £325,000 I mentioned a few minutes ago is just redeemed every 7 years if you've used it. There are also various other gifts that you can make without inheritance tax. There's the £3,000 annual exemption, so everyone can give away up to £3,000 free of inheritance tax. There are also small gifts exemptions of £250 per donee, so you can have as many nieces and grandchildren as you like and give them all £250 a year. That's okay. There's only one £3,000. And there are various other gifts you can do, gifts in contemplation of marriage and that sort of thing, which I haven't gone into on these slides. You can also make gifts to charities and political parties. They're inheritance tax free. But the big one that I want to just talk a little bit about is regular gifts from surplus income, because it's often overlooked. But just before I go into that, I'll just go back up the slide a bit to gift with reservation of benefit. I mentioned that you can give away anything you like for whatever value you like, and provided you live 7 years, it's exempt. There is a little sting in the tail if you continue to get any sort of benefit from it. So, for instance, a classic one would be you've got a holiday cottage which you use for a couple of weeks every year, and you decide to give it to your children, but you carry on using it for a couple of weeks every year. That would be a reservation of benefit, and that property would still be in your estate for inheritance tax purposes, unless you made very sure that you paid a full market value for any occupation you had. Then you might be okay, but it's something best avoided. So coming on to gifts out of income. This is a relief that is often forgotten about. That really can be very, very valuable because, again, as with PETs, potentially exempt transfers, there are no limits on the amounts involved. So an individual with a high income may find that what they actually need for their normal life is a fraction of the income they actually have. Anything above what they need for their normal annual expenditure from their income can be given away. And if it's given away as part of a regular series of gifts, then it's immediately exempt from inheritance tax. There's no 7-year rule, there's nothing else. And as I say, there's no limits. So, for instance, an individual who was in the fortunate position of being able to take dividends from a company of, say, £10 million a year, who actually spent, say, £500,000 a year, could give away £9.5 million every year in a series to beneficiaries or donees, and it would all be immediately exempt from inheritance tax, which is why you can see it is potentially very valuable. You do need to have the income. You can't give away your income and live off capital. You have to have enough income left over for your normal needs. But you can see straight away there are some quite potentially valuable planning opportunities there. And just to look at one very straightforward example. It seems I'm quite clearly getting ahead of myself. We'll come to the example in a minute. It's just worth mentioning from this slide. While this is a very valuable and relatively straightforward relief to deal with, it is important to evidence that there is a series of gifts being made. And we can certainly help with that. We often put in place a letter or a note of intent of some form, setting out what the intention is. but it's also important to make sure you have good records of what you've done, because when you come to do the inheritance tax forms for the deceased who's been making gifts out of income, the revenue do expect you to provide quite a lot of detail over a number of years of your expenditure for normal purposes and indeed the gifts you made. So record keeping is important. So while yes, we think this is a very valuable relief and we look at it whenever we can, it does require a bit of thought. So certainly if you're interested in looking at this, do talk to us. But I mentioned an example earlier, saying getting ahead of myself slightly. What about gifts into a pension fund for grandchildren? So let's have a look at the next slide. It is possible for an individual who has no income to make up to £3,600 gross contribution to a pension fund every year. And normally, in order to make a pension contribution, you need to have income. And the limit for making a pension contribution is 100% of your income or the annual allowance, which is currently £40,000 for most people. Here we're looking at infant children. So let's say a new grandchild is born. And I say grandchild because a parent cannot do this for their own child, because that brings into play certain settlements legislation and means that the gifts will not leave the parent's estate. But where a grandparent gives money to a grandchild, that problem doesn't arise. So here, new grandchild arrives, and from birth, or very shortly after birth, grandfather starts putting money into a pension for them. Now, when you make a contribution to a pension fund, you pay in the net amount. So in this case, the net total of 3,600 gross, and by net I mean net of 20% basic tax, amounts to £2,880, as you can see at the top of the example there. The revenue will then add the £720 tax, making a gross contribution of £3,600. Now, over 18 years, so up to the point the individual becomes 18 years old, grandfather will have actually paid in £51,840. There'll be there nearly 13,000, 12,920 of tax relief. So the total contributions are 64,800. And by the magic of compound interest and compound growth, assuming a rate of return of 5% per annum, which is fairly conservative, at the age of 65, that individual could quite possibly have a pension fund of over £1 million. So for a relatively small input of cash and effort, a grandparent can bequest grandchildren a pension fund worth £1 million by the time they come to retirement age. So easy, effective, very tax efficient. At that point, I'm going to hand you back to James again to carry on with a bit more detail on business property relief.
Thank you again, Patrick. Yes, one of the most valuable reliefs, certainly for business owners, but not exclusively for business owners, is business property relief. Now, BPR provides relief from IHT on the transfer of qualifying business assets at a rate of either 50 or 100%. Now, to try and quantify the value of this relief, I looked back this morning at HMRC's statistics, and it was worth about £700 million of relief in the year 2017-18. And I'll come on to why that might be relevant shortly. But just to explain a little bit about the relief and what rate applies to what assets. And I've tried to set that out in simple terms in the table on the slide. So an interest in a business, or a business, so that's basically a sole trader business or an interest in a partnership, qualifies for 100% relief. So does a holding of unquoted shares, including shares listed on the AIM market. Less often, of course, we see interest in, or rather controlling holdings of quoted shares, but if one exists, then that qualifies for relief at 50%. We do also see a lot of situations where business owners hold land or buildings or plant outside of the business, and they hold it personally. Well, if that's the case, they get 50% business property relief. So an interesting conversation we would have with many clients would be, actually, is it worth, or is it sensible for them to transfer those assets into the business to increase the rate of relief from 50% to 100%? Of course, bearing in mind all the time that there might be other reasons, income tax reasons or capital gains tax reasons, why those assets are outside the company or the business in the first place. Obviously, next slide, Patrick. Obviously, certain qualifying conditions need to be met, and I'm only going to go through the main ones here. The relevant business property must be held for at least 2 years in order to qualify for relief. Now, there are replacement rules, or rather replacement of asset provisions, whereby if one business asset or item of business property is replaced with another, then the period of ownership can be aggregated. That applies both to replacements during lifetime and on death, I think. Another extremely important one, certainly from a tax planning perspective, is that no business property relief is available if the business or company is one of wholly or mainly dealing in securities, stocks or shares, land or buildings, or in the making or holding of investments. Now, this basically says that investment assets or investment businesses don't qualify for business property relief. So the obvious one would be a property investment business. That won't qualify for business property relief and would be chargeable to inheritance tax. But that wholly or mainly rule makes tax planning quite interesting, because you could have a predominantly trading business, but which holds investments, and the whole of that business, as long as it is operated as a single composite business, that whole business would be qualifying for BPR. Now, by wholly or mainly, the courts have determined that that's a 51% test. So several planning opportunities here. One, if you do have a business, or your clients have a business that contains both a trading aspect and an investment aspect, then it's important to review that business to ensure that business property relief is not jeopardized on the trading element. Likewise, actually, it's worth reviewing someone's affairs, because if we can have investments held within a trading business or a trading group, you can have them held within different group companies potentially, to obviously maintain the commercial risk, etc. Actually, you can shelter investment assets from inheritance tax by combining them with trading activities. And as I say in the next point in the slide there, some business activities are borderline. So in that respect, then planning is essential. In terms of the owner-managed businesses, I just wanted to highlight that credit balances on directors' loan accounts. So this is where an individual has lent money into their company, typically a trading company. Those credit balances will not qualify for BPR. But if we're in a situation where that money is unlikely to be returned, and inheritance tax is important, or inheritance tax planning is important for that individual, then there could be an opportunity to swap that debt for equity, and that equity would then potentially qualify for business property relief. So with some quite simple planning, someone could improve their access to business property relief. Next slide, please, Patrick. Now, the reason I wanted to kind of introduce business property relief in that way is because recent months, or in actual fact, it's probably over the last 18 months or so, we've seen a number of groups put forward reforms to the inheritance tax regime, ranging from purely technical and administrative to full-blown proposals for the complete abolition and replacement of the current system. And I just wanted to highlight a couple of those reports and discuss what we think might change. And I think one of those areas is potentially business property relief, which highlights the reason for planning being so necessary now. I'll talk briefly about two reports. One done by the Office of Tax Simplification. In fact, I'll talk about their second report, because their first report was very much administrative. And then I'll go on and talk about some proposals put forward by an All Party Parliamentary Group relatively recently. Next slide, Patrick. So it's just to kick things off, this is a few points about the comments within the Office for Tax Simplification report, that's the OTS report. Just to put this into a little bit of context, the remit of the OTS is essentially to offer recommendations and advice about how to make the UK tax system simpler, not least for individuals and smaller businesses. But note, the OTS consider it beyond their remit to recommend the abolition of tax, so they're very much looking at potential reforms to the current system. And they chose 3 key areas of inheritance tax to look at and to make recommendations. Firstly, lifetime gifts. Now, they've proposed that the 7-year rule that Patrick explained just a while ago should be reduced to 5 years, and the taper relief that's associated with the 7-year rule should be abolished. Now, this is really a simplification measure. 7 years to 5 years, I understand, is to make life rather easier for executors, because of course executors have to look back those 7 years before death to determine whether there are any relevant lifetime gifts. And actually, taper relief, whilst it's beneficial in many situations, actually it's not as good as people might think, because it's a taper relief that's applied to the tax rather than the value of the gift. They're also proposing that the current numerous small gifts and gifts out of income exemptions should be replaced with a personal gifts allowance. Now, in many ways, this would make things simpler again, because at the moment we have a number of small gift allowances, albeit the gifts out of income exemption is particularly beneficial in certain circumstances, as Patrick has discussed previously. Obviously, a single personal gifts allowance might make life rather easier. They also looked at the interaction between inheritance tax and capital gains tax. Now, again, I think Patrick's got an example later where planning could be particularly relevant in this context. But when assets pass between spouses, they pass. When assets pass between spouses, they pass without inheritance tax. But in all situations, on death, assets pass with a CGT-free uplift in value. So the beneficiary is treated as receiving the asset at its probate value, at its value at the date of death. Whereas if that's your spouse, then they've not paid any inheritance tax and had an uplift for CGT purposes. So then it's rather easier to go and sell the asset without any CGT, or give it away without any CGT. And so the OTS have highlighted this issue as a potential area for reform, and have recommended the removal of the automatic CGT uplift where an IHT exemption, such as the spouse exemption, applies. They've also recommended looking at businesses and farms, and this is, they didn't go into too much technical detail, but I think it's quite clear that business property relief, as I've just explained, and a similar relief that applies for agricultural property, possibly require some technical reforms. And generally where we see technical reforms, that means a likelihood of reduced scope. Next slide, please, Patrick. The All Party Parliamentary Group report made much more radical proposals. They recommend a complete replacement of the current IHT regime with a flat rate gift tax payable on lifetime and death transfers. Now, just to highlight a few of the key features, they would prefer a system that taxes both death and lifetime transfers at a rate of 10%. Now, theory here, I believe, from reading the report, is that a rate of 10% is so low that people wouldn't necessarily plan to avoid it. I'm not 100% sure that's the case, but nevertheless, that was the proposal. They proposed an annual gifts exemption of £30,000. They proposed to abolish pets. Now that's the 7-year rule. So that's where you give assets or cash away, survive 7 years and avoid IHT. They would prefer to tax, subject to the annual gifts exemption, tax all lifetime transfers. Abolish the nil rate band, but rather have a death allowance that at a similar level to the current nil rate band, but only available once. Currently, the nil rate band, everyone's entitled to a nil rate band of 325,000, And actually you can use it by making transfers onto trust, for example, every 7 years. They propose few exemptions, and actually to leave only the spouse and charity exemptions in place, but to remove business property relief and agricultural property relief altogether. They also propose to abolish the CGT uplift, but not just where an exemption applies. So they propose to abolish it completely. And they also propose to abolish non-domiciled status for IHT and use UK resident or asset status as the appropriate test for inheritance tax. Next slide, please, Patrick. So in conclusion, where is inheritance tax going in 2020? The short answer is, I have no idea, and frankly, probably all bets are off given the current situation. But personally, I do foresee some changes. The government obviously need to raise tax revenues, and business property relief and agricultural property relief have been much talked about for some time now. And both the proposals that I have talked about in the last few moments have suggested reforms to those reliefs. So I would encourage anyone or anyone with business assets to consider possible planning opportunities ahead of any forthcoming changes. And as it says on the slide there, perhaps there's no better time to plan than now. And on that note, I'll hand over to Patrick, who will talk through a few planning opportunities for inheritance tax.
Well, thanks, James. Yes, so coming towards the end now, but we thought, as James has said, there were good reasons for thinking now is a good time to plan. One of those is definitely that there is a fair amount of noise out there now, as James just explained, suggesting that the current IHT regime may well be changed and potentially quite dramatically changed in relatively short order. That perhaps has been made even more likely with our current circumstances, given the amount of money that the government is having to plough into the economy just to keep it all going. And it's likely to continue for some time, obviously. Clearly, there is a need to raise taxes, and equally clearly, with a weakened economy, putting significant increases on income taxes is unlikely to go down too well in terms of a means to keep the economy going or promote the economy. So one area where perhaps money can be raised without impacting the economy too much is indeed capital taxation, and perhaps in particular inheritance tax. So I would be surprised if we don't see some fairly fundamental changes in the not too distant future, which is why we're looking very closely at anyone who is willing to listen to us at these very areas, because it may be getting close to the end of the line for some of these reliefs. So the first slide here talks about business property relief assets, and James has already alluded to it. Perhaps now is a good time to bring forward, if you're not already thinking about it, or certainly advance succession planning you may have before any possible change of rules. Right now, you can give away business assets to beneficiaries absolutely. You won't have to worry about inheritance tax because business property relief will potentially protect you. And being business assets, you also will not have to worry about capital gains tax because currently there are reliefs for them as well, which is not true of non-business assets. If you are willing to give things away but not yet willing to give up control, then the same could be achieved by perhaps making some gifts into trust. The beneficiaries may be children or whoever you've got in mind to succeed you, but the trustees will include yourself, such that you do still retain effective control of what's going on until such time as you're ready. But that can be quite effective at getting things out of your estate now and using business property relief. Traditionally, we might have been concerned about some of these actions because you may lose entrepreneurs relief. Now, entrepreneurs relief is a relief from capital gains tax, as most of you probably know. And until very recently, it allowed gains of up to £10 million to be taxed at the lower rate of 10% rather than the normal 20% rate, obviously quite valuable. Following the last budget, when that was reduced to only £1 million, that particular concern has perhaps now largely gone away, and provided you retain within your business at least £1 million worth of gain, which you can qualify for entrepreneurs relief on, you lose nothing by giving the rest of it away. potentially risking a higher rate at some point in the future. So moving on. For non-business property relief assets, as I said, you can take advantage of the potentially exempt transfer regime while it's still there. Business property relief is obviously not in point, but the other problem with doing this is while you'd have no inheritance tax if you live 7 years, because there is no rollover for capital gains tax for non-business assets, normally, you will have potentially a capital gain to worry about. Catching the trough is the headline there in the middle of the slide. And what we're talking about there is that right now, and possibly for the foreseeable future, values are obviously depressed in a lot of areas because of the economic conditions we find ourselves in. So right now, the value of some of those assets you might consider giving away could be at the lowest point they are likely to be for some considerable time, thus reducing any gain. So again, right now, this has nothing to do with the APPG and so on. Right now, because of valuations, it could be a good time to look at making certain gifts of some non-business assets and take advantage of that 7-year rule. We've also looked at loan trusts and growth share plans for investment companies. Now, a loan trust is really simple and really effective for people who are perhaps in their 60s, maybe even 70s. And it works simply because the life expectancy of such individuals is likely to be 20, maybe 30 years. Now, 20 or 30 years is a long time for investment growth. So if, for instance, you had £1 million which you didn't need right now, but might need access to, you could loan that to a trust for the benefit of your children. So the £1 million is accessible to you should you need it. The growth on that £1 million, assuming it's used to invest in, let's say, stock market investments, over 20 years, 30 years, is likely to be, it's likely that that money could double and double again in that sort of time frame at relatively conservative investment growth rates. But all that growth is outside your estate, and the £1 million you originally put in is always available to you unless you decide to give that away as well. So we think that's a very powerful, very simple form of relief, provided you're in that sort of age bracket. It's no good if you're 85 already. It's no good if you are, well, it's not as good perhaps if you're in your 40s and 50s, you'd be doing other things. But for in that bracket, that age group, it's well worth thinking about. As far as investment companies are concerned, where you have a company that is not trading, it's set up to invest, maybe property, stock shares, whatever it is, inheritance tax is always a problem for you because there are no reliefs. But what you could look to do is create a new share class which is entitled to the growth in value of the company going forward rather than any value that's already there. Now those shares, the day you create them, are worth relatively low amounts, arguably nothing, although the revenue don't like that, but certainly they can't be worth a huge amount of money. They can be given away with little or no tax consequences to the next generation or into trust, and future growth will then develop within those shares, again, outside of your estate. Relatively simple, some complexity to it, unlike the loan trust, which is more straightforward, but it can be quite helpful planning. Now, I always hesitate to talk about deathbed planning, particularly in times such as now, where sadly we are seeing an awful lot of death earlier than one would have liked because of this virus we have. But as James has already mentioned, there is currently at least a tax-free uplift for capital gains tax purposes on death. So where you have a situation where you have a married couple or civil partnership where one spouse is very ill, maybe they've suddenly become very ill, maybe it's developed over time, but they are very ill and the suspicion is that they may not be long for this world, the transfer of assets that have a lot of gain in them from the more well spouse to the sick spouse can make an awful lot of sense purely from the tax point of view, because on the death of the ill member, the capital gain in those assets is wiped out, and the assets can then pass back to the spouse that originally gifted them with no capital gains tax on them and uplifted to the new value at the date of death. It may seem rather callous, but this is genuinely very valuable planning in those circumstances, if of course it is something that can be contemplated. And I appreciate in many circumstances it wouldn't be something that was close to anyone's mind, but it is something I have seen done. Now we're very close to the end now. I'm sure you'll be pleased to know, but just mention here, we do offer McIntyre Hudson an inheritance tax health check for a fixed fee. We'll agree a fee with you for looking at your estate, working out your IHT exposure as things stand, and identifying immediately apparent IHT planning opportunities, which we can then discuss with you. That will be a fairly competitive fixed fee for doing that. You'll have an idea of where you stand, and it may obviously identify areas that you want to go into greater detail on going forward. But other than that, I hope this has been of use. Apologies for any stuttering we've had. We are getting used to this like everybody else. I hope we will hear from you or see you in future seminars that I mentioned at the start. And if there are any questions, then please feel free to fire them into us, and we will try and get back to you with our thoughts as soon as we can. So thank you very much, and that concludes this webinar.